Today, I've been asked to talk about the ways in which economic growth in emerging regions will affect international and global trade. But I'd also like to look at the environment in which we expect these trends to develop, with particular reference, unsurprisingly, to trade policy, but also to trade finance. There's a simple reason for this, which is that trade does not take place in a vacuum. It does not simply react to economic forces. Trade is as much influenced by external and intangible factors as it is by the broader trends that we perceive. Factors such as history, stability, and predictability, and the financial system and policy framework that underpin it. So I hope you will also forgive me if I stray slightly, if not completely, from my brief by also covering trade finance, which is critical to the foundations of international trade. There's a little secret that, like many of you, we expect global growth to be driven by emerging markets over the medium term. Whilst developed economies have stuttered, although some are coming back, many developing economies continue to steam ahead. And whilst we talk about a slowdown in China, it's worth remembering that Chinese growth in 2014 is still expected to remain around 7.5%. Now, we expect that the world's emerging markets expanding at a rate of 4.6% will fuel global growth in 2014. And the growth gap between developing and developed economies looks set to continue for many decades to come, driven by increased trade between emerging nations, the so-called South-South trade. In fact, analysis suggests that the value of global trade in goods is forecast to increase at an average rate of 8% per year between now and 2030. And at its heart lies increased consumption and urbanization with associated infrastructure growth. In the last 60 years, the world's population has almost trebled from 2.7 billion to 7.2 billion. Estimates are that that population number could reach 9.6 billion by 2050. Much of this growth is taking place in emerging markets, which could well account for 2/3 of global consumption by 2050. And here, the emergence of a new middle class is driving domestic demand. The OECD estimates that by 2030, Asia-Pacific alone will host around 2/3 of the world's middle class. And HSBC's own forecasts suggest that by 2050, almost 3 billion people, more than 40% of today's population, will have joined the middle classes, almost all who will have come from the so-called emerging markets. Over the same time period, the average Chinese worker's income will increase sevenfold, with similar increases across other markets, such as India and the Philippines. These newly affluent citizens are demanding a better quality of life than their predecessors. As countries move up the value chain, they need imports, from basic commodities to building material and machinery, the building blocks for vast new cities providing homes and transport infrastructure. And just consider that today, China's rail network is still shorter than that of the United States in 1880. And there are more than 80 Chinese cities with a population greater than 5 million people with no subway system. So to accommodate these billions of new consumers and commuters, the need for infrastructure, railways, and buildings will unfold and trigger an even stronger appetite for metals, foodstuffs, and energy commodities, as well as luxury brands and consumer goods. So we're now reaching a tipping point where the larger of these economies are likely to see their imports grow faster than their exports as they shift from being simply producers to consumers as well. And as new trade routes open up across this South-South trading environment, forward-looking companies from every country are seeing the opportunity to enter new markets and to contribute to and benefit from new global supply chains. Gone are the days when sourcing and production all took place within a small radius. Goods can no longer truly be said to be made in Britain or China or in the USA. Today, manufacturing is as much about imports as exports, whether in the developed or the developing world. New technology is helping companies deploy capital more efficiently by managing their supply chains more effectively, providing an increasingly detailed line of sight into their production cycle. And businesses are tapping into new markets where suppliers are no longer just large established producers, but small businesses that contribute a single component of a larger product, whether a phone, a car, or a passenger jet. But whilst these strategies offer potentially great reward, they also carry considerable risk. Evolving economies are prone to growing pains. Social development is, by its nature, socially disruptive, and instability is the bane of any business. At the same time, developing labour costs create price volatility that require companies to move with nimble feet. And we're already seeing businesses react to these challenges by diversifying their supply chains so they can benefit from the opportunities in emerging markets whilst also managing the risks. And for the first time in a decade, we're seeing a shift in production from emerging markets back to the developed world. Towards the end of last century, there was a decisive shift in the offshoring of production, when manufacturing moved just one way, from America and Europe to Asia. Today, supply chains are becoming much more flexible, with many firms looking to near or onshore their production capacity, whether to serve the domestic market or re-export to developed and developing markets. This is partly because developing countries are seeing a sharp rise in wages, but also because energy prices are making it much less attractive to transport some goods long distances to new markets. A Boston Consulting Group survey last year found that more than a half of large US manufacturers with sales over $1 billion are considering whether to reshore production back from China. And as the tectonic plates of the global economy continue their seismic shift, managing geopolitical risk will remain imperative for any international business seeking a way to reap the benefit of globalized trade in a sustainable way. Perhaps the biggest challenge stemming from all of this is to ensure that the benefits of the expansion and globalization of trade are equitably shared. As patterns of global growth ebb and flow, the production and supply become increasingly portable, and there will inevitably be winners and losers. But lesser developed countries must, as far as possible, be permitted to compete on a level playing field. Trade is, by its nature, both cross-border and global, but there's a mismatch between a trade system that is increasingly international and approaches to trade policy that remain stubbornly local. The conclusion of the first global trade deal for a generation in Bali in 2013 was a welcome step, but the vast majority of trade agreements currently in development remain bilateral or plurilateral. They demonstrate not just the difficulty in concluding a multilateral agreement across all nations, but also the recognition amongst policymakers that the economic fortunes of nations are inherently bound up with trade. To be clear, these are welcome agreements. Each one marks another step towards a more harmonized world. The OECD estimates that a comprehensive implementation of all measures currently under negotiation would cut trade costs by 10% for developed countries and as much as 15% in developing countries, so no small gain. But exclusive agreements, by their very nature, leave countries by the wayside and lay prone to the influence of regional politics or history in their conception or construction. There are often valid reasons for not including a country in a broader agreement, and this in itself can be an impetus for reform. But it heightens the need to ensure that all trade agreements, whether between 2 countries or 20, should be designed with the possibility of future multilateral level agreements in mind. We must also recognise the pivotal part played by trade finance within the global system of trade. In a recent paper, the Federal Reserve Bank of New York described the critical role that banks play in facilitating international trade by guaranteeing international payments and reducing the risk of trade transactions. Banks enable trade not only by financing transactions across borders, but by mitigating the risks involved for both parties by guaranteeing the trade. This is an invaluable function. Without a reliable international trade finance network, exporters and importers would face greater risk and incur higher day-to-day business costs. In many instances, without trade finance, a deal could not take place at all, particularly if one of the parties is considered to be higher risk. These effects would be felt disproportionately in emerging regions and by SMEs, for whom trade finance offers an indispensable form of collateral. In many emerging markets, it would be difficult to get a loan for the manufacture of goods without having trade finance in place. By the same token, SMEs could not bear the level of risk involved in such a deal without the guarantee that the provision of a letter of credit could provide. This emphasizes the fundamental need for a fully functional finance system to enable banks to support the growth of trade, both with and between emerging markets, by mitigating risk, reducing costs, and guaranteeing agreed deals. So the rise of emerging regions has already led to historic shifts in the global economy, which have had a profound effect on global trade. But arguably, the biggest changes are still to come, as emerging regions continue to grow their exports, develop their economies, and move to becoming importers and consumers on an unprecedented scale. The world is shifting around us, and the scale and scope of the changes we are seeing cannot be underestimated. There will be challenges and transformations that we can barely begin to perceive from our vantage point at the epicenter of change. As human ingenuity rises to the challenge of growing populations and shrinking resources, the solutions it conceives could herald nothing short of a new industrial revolution, with all of the disruptive implications that term suggests. Indeed, it is difficult to paint a picture of the future dynamics of trade when we haven't even begun to explore the impact of 3D printing, to name just a single example. Of course, these are forces beyond our control, but we retain the ability to set the parameters of trade, to reduce the costs as far as possible, and to ensure that the rules that govern trade are as fair as they possibly can be. The most important thing is that we all go on making the case for trade and the factors that underpin it, explaining that trade is about growth, jobs, and economic development, and that helping emerging regions to build and grow will be good for them, but it will be good for all of us. Thank you.